Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Fed Day. We just had Powell speaking at the presser. We have all sorts of things to talk about with the 10-year yield and mortgage rates. Logan, welcome back to the podcast.
Paper, rock, scissors, labor over inflation. Well, at least they acknowledged it. I think that when the first announcement came out, bond yields fell below 4% for briefly. It's just been hovering around these low levels. I actually thought the 10-year yield would get to 4.10 after that strong retail sales number, but that didn't happen. Powell started talking. Let's call it a risk manager cut. He talked about break-evens possibly being zero, which means that we could have no job growth forever, and that'll be perfectly fine now with the population growth here. So there are some things that were slightly disappointing, and then there were some things that were positive in the sense that it took them a while, but they finally admitted that the labor market is getting their attention. And it's still, we're going to get to neutral policy at some point in the future. This is not, talking about anything accommodative or anything in that nature. And here we are near 4%. So much has been priced into the marketplace already that we just go back to the economic data. And I think that's just how everything's going to go until the last and final line of defense for the Federal Reserve. Because if they're doing break evens out of zero, which means that we could have no job growth for years and years to come, well, that'll be perfectly fine with them. It's that was really disappointing, by the way, that he used a zero term. That's, in any case, I won't dwell on that. Yeah, I will dwell on that for the rest of the year.
Yeah, no, so I think this is really important, like the emotional roller coaster, because, okay, so we're here at the Gen Blue conference in Las Vegas. We're recording this in person, which we don't normally get to do. And we're watching this Fed presser in person. So first off, 25% basis point cut in rates. Great news. Lots of euphoria, not just us, but everyone online. And we saw that 10-year yield on we're watching, it's just diving. Then he starts talking, and the longer he talks, the more it goes back up. And it's for this very reason. It's the things that he identified that could give people pause about what this means.
It's perfectly fine in the sense that rates are near 6%. People shouldn't watch the 10-year yield during the Fed meetings, man. Y'all are a bunch of soft marshmallows.
I was watching
I'm telling you, all these people are like, oh my God, bond yields are rising. I was like, come on. We're down here for the 4% 10-year, and like it's
no, I don't. I reject that because in our
I'm talking about these guys online who just like people are freaking out. Why are the bond yields right? I'm like, listen, so much of what's happening with Fed policy is already priced in, and maybe some of y'all shouldn't even watch the 10-year yield on Fed days because I've seen some really crazy Fed days. This was not one of them. This was like, bond yields fell a little bit. They retraced it back up. It's like 406 right now. It's only up 3 basis points. You have people panicking. We see part of the job here is to make you all not soft anymore and realize that the bond market has volatility days. This was not really one of them. It's just there's still some people out there that still think that the market doesn't price in a lot of stuff before. And to me, it's that if they really, really wanted to, have bond yields go lower, they would talk about, maybe we could get to an accommodative stance at some point if the labor market. They don't really think the labor market's breaking if they're telling you that zero job growth is perfectly fine at break evens. But that's the way the world works.
I think that's the thing that really took the wind out of the sails if you're looking at that. So one of the things that you've set up for this meeting was that what they say is really going to show us, are they working back to a neutral policy? Are they, because they're, and he said that they're working their way back to neutral. So his language was definitely not something that the bond market's going to be like, okay, we're all on the same page. He needs to.
I think the bond yields, if anything, I think bond yields are too low after that retail sales report. I'm surprised the 10-year yield wasn't at 4.10 before this Fed meeting. It is interesting that the 10-year yield is still here with what I consider a risk manager rate cut. Who comes up with these statements?
Okay, what does that even mean? So break that down, because I don't know what a risk manager rate cut means.
It means that they really didn't want to do it, but they did it because they can't use the solid labor market anymore, because it's just embarrassing at this point. And then they come out with zero break evens. So to me, it's just they had to say the labor market's softening. You cannot with a straight face say the labor market is solid, the unemployment rate is low, population growth is slowing down. They can't really use that line anymore after we've always highlighted this. When we think about capital investment or areas where interest rate policy can affect manufacturing and housing, manufacturing jobs have been losing jobs since November of 2022. Residential construction workers have been losing their jobs the last 4 months. Housing permits came in lower, starts came in lower today. We're deeper into the COVID recession levels with elevated supply levels of completed sales for the builders. So there is a rate impact on that. I thought of this as a begrudgingly, okay, we got to say the labor market's softening and we're more in a balanced risk. So for all it's worth, I think the 10-year yield to me should have been a little bit higher before this Fed meeting and because of the retail sales report. But in any case, nobody should be complaining at all. I saw literally people were like screaming, "Oh my God, the 10-year yield's going up." I was like, really? The mortgage rates just had like one of the best weeks. And
I don't know. I think you got to give people this a little bit, because we've been waiting all of 225.
No, we have not been waiting. It's already here. Mortgage rates are basically near the low levels of the forecast. See, if it was at 6.75%, I understand it, but we're not. We are near 6%. We had a really good spreads day yesterday. So this is as good as it gets until the labor market breaks. I mean, softening is just, begrudgingly risk management rate cut. So we just go back to the economic data at this point. But again, so much has been priced in already. But the fact that they did acknowledge that the labor market's getting softer, that's a victory in that self, because thankfully I don't have to hear that. The labor market is solid. Population growth is slowing down. The unemployment rate is low. But they actually did mention that the unemployment rate ticking up with population growth slowing down is actually meaningful. So to that, I give them some kudos, because if your unemployment rate is rising and you're telling people the break evens could be zero, that unemployment rate rising in this environment would be more problematic. So he did acknowledge that. So the labor market's getting softer. So that's a victory in itself. It does make it harder to have yields really retrace up higher. So we go back to the economic data. But if the economic data gets better, we all know this Fed's not going to do much. But for now, I would say I'm still somewhat surprised the 10-year yield is below 4.10 this week, even after the retail sales print.
Okay, given everything he said, then what do you think it means to the Fed for the labor market to be breaking? We've been talking about the labor market breaking for a couple of years, softening. To your point, he did call that out specifically. But what would it take if he's saying that if we didn't grow jobs at all from 0%, it'd be okay? What does it mean to break?
The same thing we said in November of 2022. You need jobless claims 4-week moving average heading toward 323,000. We don't go into the recession talk until that happens by itself. Okay. But the jobless claims spike that we saw last week, Texas flood, people, filing for unemployment benefits that didn't really need to. So you take that out of the equation. As we've always said, that last line in the sand is jobless claims. And jobless claims on a 4-week moving average is not near 323,000. The Federal Reserve would tell you that jobless claims have to get to 400,000 for them to get worried that the labor market's breaking. But to me, it's like when we start heading toward 323,000, the labor market's already broken at that point. If it accelerates higher, you're already in a recession at that point.
So you have not changed what you think it means to break it based on what he said today?
No, it even reaffirms it, that if Jerome Powell is telling the American public that we could have zero job growth and we'll be perfectly fine, I just at least make it 10,000. Don't say 0K. God, that is such a demoralizing statement that We could have no job growth for 10 years in a row. It'd be perfectly fine because population growth. And again, this is not even a coherent thought. Manufacturing jobs have been going down since November of 2022. Population growth was actually good last year for the labor force. They used that as a reason. Now you just see the continuation of sectors being hit with higher rates, and they completely ignore that. Do you know why they ignore that? Because they don't really want to cut rates, but they had to do it. They had to bring the labor market. I think that's just one of these things where even for the Federal Reserve, they couldn't deny that that the labor market's getting softer. But to his point, he did say the unemployment rate did tick up, and that that is material to them.
So, he emphasized again, we have a dual mandate. Both, they're in conflict. They always are, inflation versus job growth. He did talk a lot about the lack of job growth, right? I mean, I to your point, early on in the speech, I thought he was really talking up, maybe some of our talking points. Then it did not. It went sideways. So, okay. To your point, mortgage rates, at least when we jumped on this podcast right after he stopped talking, we're up like 2 basis points from yesterday, which was a low for the year. So, to your point, can't really complain about
mortgage.
Like
we've said for a while now, it's really hard to get under 5.75% with Fed policy here. And the market already knows that. I mean, they've already gave an extra quarter rate cut going down the line in 2026 and 2027. They're already projecting that the growth rate of inflation after the tariff one-time hit is going to go lower, below 3%. But it's, again, to get to even 5.75, you need better spreads and you need a dovish Fed. You had a initial slightly dovish Fed on the statement, but when you listen to Powell talk, really, it's just they could not come with a straight face and say that the labor market is solid, the unemployment rate is low, population growth is slowing down. So it's a win for the week. We're near 6% mortgage rates. It's the spreads are getting better like they should. So if you're hyperventilating over the 10-year yield, having a very quick report, we had some grown-ass, they had to block some people on Twitter because these grown-ass men are just like, oh my God, the 10-year yields. I'm like, you are the softest marshmallow in the world. Rising yields is not going to kill anything. So the running joke I do is whenever the 10-year yield gets under 4%, I say we survived the 4% 10-year because some of y'all men just can't handle a little volatility. Stop acting so soft. It's embarrassing.
Okay, so one of the things that Powell downplayed was the fact that they have a new Fed member who was just sworn in. I think welcome this morning, right? Because Stephen, I still am not sure how to say his last name.
It's Myron. Just say Myron.
Myron, but I heard it a couple different times during this press conference.
Everybody.
Okay, because I want to be right. Anyway, this new Fed member just this morning, right? And he was asked Powell was asked a question by a reporter on, with this new Fed member and the voting, is it going to change? And he was like, you have a rotating cast of 12 that vote out of the 19. And he's like, really the only way for one person it's hard for one person to have outsized impact on the vote. They would have to influence the other people, convince them. It's one of the reasons the Fed is set up the way it is as far as voting. So he really downplayed that, but we know there's huge pressure on not only Jerome Powell, but all of the Fed members, right? With everything going on with Lisa Cook. He was also asked about Lisa Cook. He declined to comment. He said he really shouldn't comment on that. But there she was today.
Didn't they find Scott Bessent had 2 primary resident houses?
Yes, I read that. Yeah, yes, I read that this morning. So I do think if you scratch the surface, you might find a lot of people with second homes or vacation homes that have, their mortgage paperwork is not up to par.
Well, I mean, for Stefan's, the interesting aspect is he's kind of also not in this super growth camp with his first Fed vote out there. So to me, it's kind of a half and half. I thought the initial report was fine. They acknowledged the labor market. Okay, fine. But when Powell started to talk, you could just see it in his verbiage. They really, really just did not want to cut, but they did. And admitted the labor market's getting softer. But if you're telling the public that you could have zero job growth and that is perfectly fine, so in any case, that means it goes back to all the way back to 2022. For them to really start to get dovish, they really need jobless claims to break, because jobless claims is not something you could hide behind anymore. You can reduce the population. They went from like 120 to 80 to 75 to 50. Now they have a zero in there. That is remarkable to think that the U.S. has that kind of labor market now, where zero job growth would be something the Federal Reserve president would actually, or chairman would actually say. So jobless claims is the final line in the sand, and we get this by the time this podcast comes out. We'll see where it's at. It should fall noticeably in the next report, just because that was a very, very abnormal spike that we saw in the data line.
Okay, so where would you think job growth should be? If like what's the right target for the U.S.?
I'm sticking to that 73 to 78,000. Of course, nobody really knows what the number is out there on population growth or immigration or anything like this. But I've seen two sectors of the economy that, during a time where population growth was fine, been losing jobs, and that doesn't look to me to be population growth. If housing permits are at a deeper recession levels, that's a rate story. If manufacturing has been losing jobs since November of 2022, that's not a population growth story. So there are things out there that the labor markets get soft. A lot of people are harping on the Federal Reserve now for young unemployment rates are accelerating higher. Black unemployment rates are above 7%. So they're going after Powell for things that I just don't think they really care. I just think they're just not going to get to that next level until jobless claims break, and that's the models they have used, and softening but not breaking. That's the entire U.S. economy. It's still holding up, but it's not in that kind of last stage recession. And here it is. I mean, it took a lot for them to just begrudgingly admit, oh, well, okay, the labor market's getting softer, but I'm just going to take that as a mild victory for them to come out there and say that, because it has been so long since I've said that, since I've seen them actually take that stance.
So interesting. Mild victory might be do you think that's the headline for the whole?
No, I don't think it's. I think when Powell started talking, it just kind of
it didn't feel like it did not feel like a victory to me at that point.
But again, the story is, as it always has been all year long, the labor market getting softer drove rates down. The labor market getting softer last year drove rates down. The labor market, or the fear of the recession in late 2022, early 2023, brought rates down. The 10-year yield can get you there with whatever, $5-10 trillion of debt we need to refinance, and nobody wants to buy the 10-year yield, and we're broke. None of that stuff matters. As soon as there's a growth scare, money goes into the bond market. So we fall back to the economic data. We track this every single day. I'm still surprised bond yields are still this low after that retail sales report. They did mention that. Powell just mentioned that. He's like, hey, by the way, did you guys see those retail sales? Oh, yeah, maybe it's the upper income people, but still, it's retail sales growing. So they are going to wait, man. They are going to wait till that very last to maybe go a little bit dovish. But considering where we are right now, purchase application data, another positive week, 3% week to week, 20% year over year. Now, out of that 7 weeks that we've had since rates have been below 6.64%, 6 have been positive, 1 has been negative. Those are the curves that you want to see in the purchase application data, that even though the year-over-year growth was here all along, we never had the consistency on the week-to-week. This looks like what we saw late 2022 in mid part of 2024. So we just need about 6 to 8 more weeks of that. You got something legit, good to go, and that's encouraging on that front, especially after the housing starts data.
I think it's encouraging too that, you've been talking about we don't need 3, 4, or even 5% mortgage rates. If we just get down close to 6, which we are now this week, down close to 6%, that we can see growth. That's what you're seeing in the purchase application data. And that's what you've been looking at, like every time over the last couple of years. When we get down there, then housing data gets better.
You have to have a model for this, and we've kept a close eye. It's really between 6.64 down towards 6. And this is the third time this has happened. This is the third success. The Trinity is in. So that is a working theory now that has been tested a few times. The only thing is that this year is the first year that we've had in many years where purchase application data is positive weekly and it's up double digits year over year. We have not had that out there. So it's a positive that we're getting this. I would really love to see 12 to 14 weeks of purchase application data being positive weekly and the year over year growth to see how that impacts the sales data. But take it as a victory, man. So far this week, with the spreads getting better and mortgage rates near 6%, something 4 or 5 months ago, people could say it's impossible. There's all these reasons why it could not happen. It's here. So y'all need to relax about some moving yields on a Fed day. Woo, goodness gracious. We've had some wild Fed days. This was not one of them.
I don't agree in the sense of like, it's just discouraging. It's like seeing it go down, down, down. Yay. Okay. So here's the other thing. I don't watch 10-year yield. I don't see that. I'm not like you, right? Most people are not like you where they're watching it. So on a day like today, everyone is watching it for good reason. And so it did feel like a big.
It just sounds like to me some people didn't lock their rates and they're petrified. So y'all get greedy sometimes. That's what happens. Y'all think, oh, we're going to play the Fed day, and here it is. And then all of a sudden, oh my God, you don't even know it. So you know what that sounds like? That sounds like stock traders. Stock traders on margin. Always panicking. Oh my God, this and that. And so it is what it is. That's how the marketplace works.
It is. The other thing I wanted to bring up is that Powell did address like the integrity of the labor data specifically. He had a question from a journalist that was like, hey, these revisions came in so big. What do you think about that? And Powell, responded that yes, they understand the limitations of the data because it's survey data, because they're having a really low response rate. You get these kind of big swings. And his take was, if you want it to get better, you need to put more money into BLS, right? So that they can get more people on the survey. But it seemed like he at least acknowledged that, like, there needs to, this is a pain point for many people.
Housing starts to have been in a recession for years. Manufacturers have been losing jobs for years, and nobody should be blaming the BLS reports. It's in there in the data. They are purposefully ignoring that. They didn't bring it up at all. They did not bring it up. They talked about, somebody brought up the question, are tariffs causing the weakness in the jobs? Yes. We had that discussion on a few podcasts ago. We saw what happened in 2018 and 19 where business investments just didn't know what the rules were. Godzilla tariffs and everything we're doing does cause chaos in making choices, especially farmers are stressed out, small business on certain things. So clarity will help on that front, but let's just keep this very simple. Mortgage rates got down near the low end, at least of my forecast. And this is as kind of good as it gets unless the labor data really starts to get weaker. But again, jobless claims is the key thing to everything, because the Federal Reserve, you cannot have a meeting like today if jobless claims are above 323,000. There's nobody that's going to let Powell get away with that if that was the case. But it hasn't gotten there. Why? Because the labor market hasn't broken yet. Breaking is something different. And Powell noted retail sales were fine. It was good. It was strong. It beat estimates. The unemployment rate is low. They really are focusing on an old model that really needs to see jobless claims break. And I still say take the victory this week. They finally said labor market is getting softer. That's a small step in the right direction.
Okay, well, we will end it there. Logan, thank you so much. I feel like we've been on pins and needles all week just trying to see not what he did. It's not surprising that we had a 25 basis cut, right? In fact, one of the reporters asked him, hey, was 50 ever on the table? He's like, basically 50 was never on the table. So that wasn't the surprise, but we were really listening to what he said. And sure enough, he gave us a lot of information.
What was the Pink Panther movie or whatever, the cartoon where they have a cane and they just like knock someone out of the stage? Like Powell should have just said, hello, I'm Jerry Powell. And then somebody should have just taken about it. But in any case, I think it was a useful Q&A, just because I never thought I would see the day where we would have the Fed chairman say zero job growth is now possibly the run rate. Wow, that to me is like something I'm always going to remember, that we're at that stage of our society that population growth has slowed down that much.
All right. Well, thank you so much for being here. And here we are in person. This is so unusual. We did one in person yesterday, an in-person podcast with some extra people. That was fun. And get to do it again today. So, Logan, thank you so much.
Go Federal Reserve. Yippee-ki-yay. Welcome to the party, pal.